You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Happy New Year. Happy New Year, Brandon. How are you going? Did you go away over New Year's? What did you do?
Nah, I stayed home. I was just chilling. Actually, I should have had some time off, but I kind of kept working while the boys were away because I wanted to get my videos prepped.
Brandon, that's a sin.
I was one of those.
That's a sin. You can't be doing that.
No, it was good. No, my New Year's, I went over to my mate's place. I was just chilling out. My grandma was in town, so hung out with her. And then went to my mate's place and just had a very fun evening of food and drink and banter.
Yeah, nice. It is
as it should be.
It is nice to have a quiet New Year's every now and then because you get to actually recover. I feel like I had a break, but I didn't recover. Like I'm still recovering.
Right. Right. Fair enough. How's your New Year's?
Yeah, it was good. Went down to the beach, did some camping, which was always a fun thing to do, and just catch up with some mates. So that's always fun. Yeah.
Awesome. Nice. Sounds good. Feel well rested, ready to get into another year of podcasting?
I wouldn't say, I'm getting there. I needed a couple of days. Give me a couple of days and then I'll be fully rested. But I am super excited for, it's always good at the start of the year. It's kind of like, it's like a psychological thing, but it's like a reset button. Or even at the end of each week, it's like a reset. But especially at the end of the year, it's like you can set new goals. You can, scrap all the mistakes you made last year and just, hit the ground running all over again. It's like you get a new reset. So it's always exciting.
Are you a big goal setter for the year ahead?
Not a big
goal setter. Do you have any goals you're aiming?
I usually I don't like to set a lot of goals. I see some people set like 10, 15, 20 goals, like business goals, personal, all of this stuff. I'm not a person who has all of these different targets. I tend to just think of one or two things, usually just one thing that I want to have achieved by the end of the year, a big kind of audacious goal. And that's usually what I do. And then more of my focus is on the week by week or month by month tasks that will get me there rather than kind of setting, a lot of long-term goals. Are you a long-term goal setter?
Yeah, I'm not. I'm a weird goal setter. I'm certainly not a role model goal setter because I know like where I want to get to, and I'm driven enough just by myself to not really need to break it down into like do this, then do that, then do that, then do that. Yeah. Like for us, the big goal this year is to hit like 1 million subscribers, but also to have like Profitful relaunched, to have we need 2 more editors, social media manager, and I want to get some people in to help me with script writing and stuff like that just to make my videos better. But I know that's like, I don't want to be like, by the 31st of December 2023, I must have done. It's just like, I know that's what I want to do. I know that I'm going in that direction, so I just kind of chip away at it over time. I don't know. I've never been someone. I'm not a personal quality of mine is I don't quit things that I start. A lot of people I find they just, if something goes wrong or they hit a little speed hump, they just kind of stop. I've never had a problem with that, which is good. Yeah. But yeah, that's kind of what I'm trying to achieve.
Yeah. I mean, it's definitely easy to have that mindset as well when you're doing kind of what you're really into. Like you obviously love what you do, so it's easy to just kind of push through the barriers. Where I think a lot of people set goals for things that they're not super passionate about or things like that, and that's where the challenge comes. But I mean, that's the other thing is sometimes things you want to achieve are going to be difficult, and if you want to work out consistently, that's not always going to be something that you love to do. So it can be challenging. Yeah. But yeah, I'm in a similar situation to you, I think. Yeah.
All right. Yeah, it should be a good year ahead. I'm keen to keep the podcast up this year, that's for sure. Whew, yeah, it's going to be good.
How many episodes in a row can we go this year?
I reckon we can do Well, we haven't missed. Oh, I guess it depends on you, doesn't
that's
it?
That's what I mean.
You sicko.
How many times? We should have put that in our predictions last week. How many times am I going to get the flu this year?
No. Sorry, Brandon. I can't come in. I'm sick.
I'm sick. Yeah, that has to. There's no, surely I can't be getting COVID again this year. That can't possibly
Hopefully
happen.
not.
It's not going to happen.
We need
That's my
COVID-free 2023.
That's my New Year's resolution. Don't get COVID.
That's your slogan. Good luck.
Yeah. No. What have we got to talk about today? We got. I think Meta got slapped with another. Well, not yet, but it looks like they're going to get slapped with a massive fine. We have Fed minutes. From the December meeting, which sent the markets up massively last night. So markets were very excited about that. What do we have? The Dubai is planning to boost trade.
I'm going to talk about Dubai's very, very large plan that they just announced to boost their trade and grow their economy. I like Dubai. It's a very interesting kind of case study. I don't know. It's just an interesting place. Tesla deliveries and what happened to the stock, because there was very, very large stock movement after that. We might, if we have time, we'll talk about the UK recession. It's tipped to be as deep as Russia's recession, which is pretty
That's kind of
insane.
mind-blowing.
Yeah. So we'll see how we go. All right, let's do it.
Yeah. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, or you can do it manually using Excel or one by one. And when you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. So on index funds, for example, if it has an automatic reinvestment plan, you don't have to do those calculations. It'll do it. Currency gains, if you buy shares internationally or you hold foreign currencies, which has been a big one over the past 12 months, and assuming there's going to be more rate hikes or rate cuts over the next year in Australia or the US, those currency fluctuations will likely continue, so you've got to be tracking those. And then it also helps you when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, as well as use the tax time to calculate things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, and you can track up to 10 holdings for as long as you want. Or you can also use that link to sign up to a paid plan for more premium features, more premium reporting. And if you do that using our link, you'll get 4 months off a yearly subscription. So if you want to get your tax affairs, your portfolio in order in the new year, then check out Sharesight, sharesight.com/young investors.
I got a little question for you before we start.
Okay.
I saw this stat that Steak actually put up on the Instagram. Guess what the cost per minute was for the Sydney New Year's fireworks show? Cost per minute. Australian dollars. Australian dollars.
Okay.
Sydney fireworks.
God, I don't know. Per minute. Okay. So I'm trying to...
Apparently, hang on. Where did I read? Apparently they let off...
Okay, yeah, give me some
what did it say? 8 tons of fireworks.
8 tons. That sounds like a lot. Well, I first of all, I don't know how long this show goes for. I'm guessing it's for like 5 minutes, like 10 minutes.
No. I think it's like at least 10 minutes.
Okay.
Yeah.
Okay, so we're probably
10 to 15 minutes.
So we're probably in
normally.
maybe even in the millions per minute. I have no idea though. I have no idea. I'm gonna say 1 million, but I feel like maybe that's too high. I'm not sure.
Yeah, it's too high.
Okay.
$350,000 a minute.
Wow. So which
is still a lot.
What was the total? Oh, does it not?
I think they said. Well, I think it said here that they estimate that each one they have a budget of $7 million.
Wow, that's
crazy
crazy
for the fireworks.
Yeah, that's insane.
Yeah. The show is truly mad. It takes 15 months of planning and 18 shipping containers packed to the brim with pyrotechnic equipment. Love it.
Did you see that fireworks shop that a car ran into? And all the fireworks went off? Yeah, it was in the US, I think maybe like a month or two ago. And you can find it on YouTube if anyone's interested. It's just, it's kind of crazy. The car drives into it and they just start to slowly go off and then the whole thing just just goes off.
Oh my gosh,
Yeah.
that's insane.
Yeah.
That is insane.
Crazy to see.
Yeah, I saw a meme. Sorry, we should actually get to the news. I saw a meme of like one of those Instagram reels or whatever of someone just letting off a firework, just like, except they let it off and then the wind takes it.
Yeah.
And the wind takes it, and it's just like you could just see it coming. They're in this big apartment building. There's just this one guy with his window open.
Yeah, I've seen that one. That's crazy.
You've seen that?
Yeah.
Straight into the guy's window.
Bloody fireworks.
Yeah, no wonder they're banned. I was always like, as a kid, why are they banning them? That sucks. And now I'm like, yeah, okay, makes sense.
Yeah, I don't know.
Anyway, all right, should we talk about some maybe some investing news?
Yeah.
What happened with the Fed minutes? Can we go through the Fed minutes? We'll get that kind of done off the bat.
Yeah. Okay. So
what's going on?
Yes, the Fed minutes, of course, is the kind of the summary that we get out of the meeting that happened in December. So in December they did a 0.5% rate hike, and that's really all we get out of that meeting. And now we get kind of the summary of what happened and what they spoke about. The summary said, participants generally observed that a restrictive policy stance would be needed to maintain the incoming data provided maintained until the incoming data provided confidence that inflation was on a sustained downward path towards 2%, which would likely take some time. Went on to say, in view of the persistent and unacceptably high level of inflation, several participants commented that historical experience cautioned against prematurely loosening monetary policy. So essentially, the last time that the US has seen a massive inflation surge, which was in the 70s, rates were eased too early, and then there was this second larger wave of inflation. And that's essentially what the Fed is continuing to say. We don't want this to happen again. We can kind of look back on history. We've seen exactly what happened. We don't want that to happen. We don't want to be premature. We want to make sure we get inflation down to the target. And it's interesting because it kind of goes against what the market is currently expecting to happen, let's say, over the next 12 months. So we can always look at what the market thinks by looking at bond prices and where they sit relative to where interest rates are now. And that gives us an indication of what the market thinks interest rates will look like in a month or in 12 months. And bond prices at the moment show that the market expects just a 25 basis point hike next month, so a very small hike, and then even potentially a rate cut by the end of the year, which is a very different situation to what we're hearing at least the Fed say, which the Fed is saying, no, we're going to keep going until inflation gets under control. And it is interesting. I always find it interesting to look at different, not to use them in my investing process, but to look at what different investors are making in terms of macro predictions, because there's always a wide variety of different macro predictions, and then we kind of get to see what actually ends up happening. And we kind of got one of them from, and this is not super related to what the Fed meeting, but we got one from Michael Burry, which is always interesting to look at.
I saw this as well, yeah.
Yeah, so he tweeted last week, and he basically gave his nice, clean summary of what he thinks is going to play out in terms of the Fed and inflation. The quote was, inflation has peaked, but it's not the last peak of this cycle. We're likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. The Fed will cut rates, and the government will stimulate. And we will have another inflation spike. It's not hard. So basically, Burry is describing exactly what happened in the 70s. He thinks it's going to happen again. And at the same time, we've got the Fed saying, no, we've seen what's happened in the 70s. We're not going to repeat that. But it's also what Burry talks about in that is the challenge that the Fed will essentially face, which is if the US does go into recession and say inflation is going down to 4%, 3.5%, it's going to be hard for the Fed to justify not stimulating the economy and helping them get out of recession when inflation is still going down, or if it's still going down. So it's going to be interesting to watch it play out. Yeah.
And you can think like the media narrative, the more the media will gang up on the Fed, and everybody will start hating the Fed more and more and more if they're still like maintaining a tough stance, but inflation's gone from 8, 7, 6, now it's 5, now it's 4. 4% still high.
Yeah.
It's still not what they want, but maybe comparatively to where we were at like 8, 9%, maybe everyone's thinking, 4%, great. Why are you still come on, loosen up a little.
Yeah.
I'm like sweating. My business is almost, going under. I've got no discretionary income. Like, come on, give us all a break. And then that just snowballs into a big media narrative. And then they're like, I don't know, feel some pressure and lower rates or stimulate the economy and then it just doesn't work. And yeah, who knows? It'll be interesting to see. They do seem, I don't know, the Fed chops and changes all the time, but it seems like they're fairly committed to this kind of policy stance.
Yeah.
Of at least they're acknowledging, like, look, we saw what happened in the 70s. We're not doing that again.
Yeah.
Whether that actually plays out and they follow that is another matter. But it's good that they're at least recognizing it, I guess.
Yeah, and it's been, even though technically the US was in, if you use the 2 quarters of negative GDP, technically the US was in recession last year. The labor market was extremely hot and still is. So it's been easy for them to justify. It's been very easy for them to justify rate hikes with high inflation and a very strong labor market. If the labor market weakens next year, maybe as some of the rate hikes that we've seen flow through to businesses, so consumers start to spend less because their consumer debt is higher, or businesses that have high debts start to see those debts roll over, and businesses start to cut staff, and the labor market weakens a bit, then it's going to be an interesting situation. Really what we see happen. And as always, these are all, what inflation does, what the labor market does, a recession, not a recession. We don't know what anything's going to happen, but it's always interesting to observe what the Fed says and what they end up actually doing, because those two things are not always the same, as we've seen a little bit of through the last year. Sometimes they say one thing and then they end up doing something completely different. And at the start of last year, we thought there was going to be 3.25% rate hikes, and there was, 3.5% in total or something like that, 4%.
Yeah.
I think it was 4% in total, actually. This year, they're expecting about 1%, so we'll see.
We'll see. We'll see.
We'll see what happens.
Yeah, that's interesting. Yeah, so true. But goes back to what Peter Lynch says, just don't waste your time as stock market investors looking into macroeconomics too hard, because even the people that are calling the shots on interest rates couldn't tell you where interest rates are going to be in 12 months from now.
Yeah. Yeah, exactly. Did you see? So markets reacted violently based on this. The overall, the S&P was only up about less than 1%, but the tech companies moved a lot. I haven't looked too closely, but just looking at my watch list, I just saw plus 8%, plus 10%. So it was,
really?
Crazy. It's just insane how much focus there is on what the Fed says. It's not even they haven't even done anything. They just said how they're going to behave, and they're actually being kind of negative in a way. They're saying they're going to be very harsh on inflation. So it's very interesting to watch markets at the moment. It's also the beginning of the year, so you're also experiencing maybe some people recovering some of their tax loss harvesting to some extent.
Bit of churn, very interesting. Yeah, we'll see what happens this year. I've put all of our predictions down into a doc as well. Okay. And saved the doc. Great. So it'll be much easier for us to get our predictions back for the end of year episode next year.
Yeah, fantastic.
This year rather. All right. Shall we move on?
Yeah.
Let's talk about the UK. Let's talk about the UK because this was quite a surprising headline to me, and it's kind of in the same vein as what we're already talking about with macroeconomics. The UK recession could be as deep as Russia's. That's crazy. Pretty mind-blowing, considering that literally everybody is ganging up on Russia to punish their economy. And that could just happen naturally in the UK.
That's insane.
So that's I shouldn't say that with a giggle or anything, because that's actually quite depressing. It says here the UK economic contraction of 2023 will be almost as deep as that of Russia, economists expect, as a sharp fall in household living standards weighs on activity. Gosh, I can't read today. We're a bit rusty getting back into the podcasting game. In its 2023 macro outlook, Goldman Sachs forecast a 1.2% contraction in UK real GDP over the course of the year, well below all other G10 major economies. This is set to be followed by a 0.9% expansion in 2024, the lender anticipates. So again, we shouldn't read too much into this because it's literally just what Goldman Sachs is predicting. So, but I still think it's interesting, and they talk a little bit later that it does align with some broader estimates as well. The figure places Britain only fractionally ahead of Russia, which the bank projects will see a 1.3% contraction in 2023 as it continues to wage war in Ukraine and weather punitive economic sanctions from Western powers. This will be followed by a 1.8. I love the wording. This will be followed by a 1. It's like, yeah, right. You don't know. This will be followed by a 1.8% expansion in 2024. Goldman figures suggest. The Wall Street giant forecasts US expansions of 1% in 2023 and 1.6% in 2024. Germany, the next worst performer among major economies after Russia and the UK, is expected to see a 0.6% contraction this year, then expand by 1.4% next year. So there you go. Goldman's projections for the UK are below what it cites as a market consensus that sketches a 0.5% contraction in 2023 and a 1.1% expansion in 2024. However, there's a lot of reading here. However, the Organisation for Economic Cooperation and Development has also forecast that the UK will lag significantly behind other developed nations in the coming years, despite facing the same macroeconomic headwinds, putting London closer in performance to Russia than the rest of G7. So
there you go.
So this headline was kind of triggered by what Goldman Sachs said, but there's other kind of predictions that are similar. How crazy, man! I really feel for people over in the UK. This cost of living crisis seems like I obviously lack a lot of context just because I don't live there, but it seems like it's pretty nasty at the moment.
Yeah. I mean, they've certainly been more exposed to some of the worse inflation pressures than other parts of the world have seen, and that's just had a massive flow-on effect to the rest of their economy. And it's a very difficult situation. They're definitely going to be in a much closer, much heavier sort of stagflationary, very likely much more of a stagflationary situation than, say, the US, where the UK's inflation is extremely high and not really showing any signs of coming down yet, maybe even expanding. I think it was expected to continue to rise through the next couple of months. At the same time as a recession occurring, that is going to be very, very difficult for their central bank and government to deal with, whereas the US is in a little bit more of a better position where if they did go into a recession, then at least inflation is on its way down, at least so far. Although neither are great positions to be in.
Yeah, let's just keep piling on the bad news. The UK Independent Office for Budget Responsibility projects that the country faces its sharpest fall in living standards on record.
Yikes.
Alongside Finance Minister Jeremy Hunt's budget statement in November, the OBR forecast that real household disposable income, a measure of living standards, will fall by 4.3% in 22-23. Yeah, crazy. Consultancy firm KPMG projected that the UK real GDP will contract by 1.3% in 2023 amid a, quote, relatively shallow but protracted recession, before seeing a partial 0.2% recovery in 2024. The squeeze on incomes was cited as the main driver as higher inflation and interest rates significantly curtail household purchasing power. The Bank of England raised rates by 50 basis points to 3.5% in December as it looked to rein in inflation, which eased slightly in November from the 41-year high in October. But yeah, I can't remember the exact inflation rate right now, but it's still very high.
Yeah, I had a feeling it was just under 10% or something. It went just over 10% to just under 10% or something. So yeah, got any good news out of the
crazy.
UK?
Yeah, and unfortunately not. But it is crazy, all this talk about inflation and actually, because we've not really lived through an inflationary period in our in our adult lives anyway.
No.
We've had pretty much low inflation for forever. But even just feeling it a little bit, and it's not super bad here in Australia. And I guess it's like it kind of starts giving you context, and it makes you realize just how bad some of like those like a Zimbabwe or something would have been. Like when inflation didn't just stop at 10%. It went to 20, it went to 50, it went to 100, it went to 500, 1,000%, 10,000%, and it just didn't stop. Like, even just feeling a little bit of a pinch in living standards now, from our perspective, can really make you think how much of a crisis for a country like hyperinflate. Like, it can just cripple the currency. It can just cripple a nation. So
yeah, it's
kind of interesting. Yeah,
it's definitely a different environment to be living. I mean, even if you think about something like Turkey, which has I think about 40% annual inflation at the moment, but has historically had a very large amount of inflation regardless, and you can go to the bank and get a pretty substantial interest rate. It's just such a different environment to what we're used to, which is basically you get nothing out of the bank, and inflation has been basically nothing. So.
Yeah.
It's
just so bizarre.
Yeah, it is strange, because especially when we look at periods that we're comparing to in the past, like the 70s, when we're talking about the 70s inflation crisis, we're talking about 8-9 years of in total through which there was periods of high inflation and low inflation, but it wasn't 1 year and it was gone. It was kind of this long prolonged period of trying to get this beast under control. So it is I don't know, it's very strange to kind of watch it unfold, and it's very difficult to know what's going to happen. We kind of just have to take it year by year and see how it plays out.
Yeah, it is weird because when you do look back at the 70s, it was like a whole decade of well, not always high inflation, but waves, cycles of very high inflation with each peak. So it started I think in around 1970, where inflation crept up over 5%, came back down to maybe 3-ish%, spiked again up past maybe 12%, came back down to about 5%, and then went up to 15%. So you get these cycles, and that's exactly what you were talking about before. That's what Michael Burry is saying will likely happen again. Like, the same human psychology will kick in, the same pattern of behaviors will happen, and you'll get these recurring cycles of inflation.
Yeah.
But we'll see, I guess. Yeah, it's pretty rough. Anyway, enough of that. Was there anything else that I had to say on that? No, I don't think so. No.
Yeah.
What would you like to talk about?
We could talk about Meta. Meta's
yeah.
Meta's been fined. It's not really. We could talk about one of these every week, basically. I think.
What's new?
Yeah. What's new? What's news about this? No, they've been fined again.
They've copped a non-recurring expense.
Yes. exactly. Yeah. This is.
We'll put that down in the books as non-recurring.
Adjusted EBITDA. Take out all the non-recurring fines. It's actually funny because the regulatory body that did fine them, which I'll talk about, has a very strong habit of finding Meta. So I'll give you some stats on that.
How many years in a row do you have to cop a non-recurring expense, aka like a fine, before it becomes a recurring expense?
Yeah.
Surely they'll update the accounting. By the way, if you're a social media company or like an online tech company, if you cop fines for 3 years in a row, you have to now account that as a recurring expense.
I'd love to see.
Anyway, sorry.
Meta. I'm sure Meta must have board meetings where they talk about how they budget for these kinds of fines, because they are massive. They're definitely meaningful. Yeah. They're not small. I mean, this one is 2 fines that total $400 million US. So that's just.
And for a company that big, they would definitely strategize that. They would predict all scenarios. It's like, if we did this with our business, we would project we'd make this amount of revenue. It would cost us this much, and then definitely they would look at every single angle. What's the likelihood if we did this? How much money would we make? If it was deemed that we overstepped, how much would we get fined? They would go through every single scenario to figure out what they want to do with their business and what risks they want to take.
Yeah.
Because that's unfortunately one thing I've learned is that a lot of businesses just they just push it. I don't know. They just push it.
Yeah. Well, in this case, the fine goes at the heart of what Meta does, which means they can take kind of very large fines to continue to breach this particular law, because if they have to comply, then the losses would be far more significant. So
there you go.
So to get into the details of it, so it's two separate fines for breaching European privacy laws. The regulatory body is the Irish Data Protection Commission, said that Meta should be ordered to pay two fines. One is 210 million euros, or about 222 million US dollars, over violations of the European Union's GDPR, which is the General Data Protection Regulation. And then the second fine is 180 million euros for the same for a breach of the same law by Instagram. So they're basically able to fine both Facebook and Instagram for breaching, and that kind of doubles up the fine, which is kind of interesting.
Wow.
But the GDPR, which is the legislation this falls under, essentially aims to restrict how businesses use people's data. So it's all about data use. And the problem in this case is in regards to Meta's personalized advertising. So currently how it works is simply by signing up, saying yes to the terms and conditions, and using Facebook or Instagram, so just logging in, you're essentially automatically agreeing to allow Meta to process your data within the app and then use that data to provide targeted advertisements. Pretty standard for platforms that run advertisements. Part of the automatic kind of contract that you sign when you use the app is that they're going to be able to use your data to do advertising, and therefore you can use the platform for free, but you'll see ads. The EU is arguing that they need to allow users to use the platform without giving up their data for advertising. So, in other words, instead of people just automatically opting in to targeting when they sign up, and if you don't want to be targeted, don't use Facebook or Instagram, they say that Meta needs to ask every user to opt in to tracking. And if they choose not to opt into tracking, that they can still use the platform without tracking. So they want to essentially take out a very key component of Meta's business, which is that in exchange for getting access to this incredible social media platform or multiple platforms, they need to be able to track you. And essentially, it would work. If anyone's kind of familiar with the Apple iOS change, it works very similarly. So it doesn't stop all tracking. It's not like Facebook can't use your age or your name or the Facebook groups that you associate with to track you. They can still do all of those things because they're within Facebook. It's to do with behavioral tracking or third-party tracking. So tracking you on other websites where essentially a business can use what's called a Facebook pixel. It's a little bit of code. They put it in their website and it tracks you once you leave their website, tracks you onto Facebook, and then Facebook can put the ad in front of you to say, hey, you didn't check out. You put this in your cart, but you didn't check out. Why don't you buy this? So that's what it's all about.
It follows your behaviors. Yeah.
Exactly, your behavior online. And it's kind of crazy if you've ever done running Facebook ads, how detailed the targeting is sometimes is kind of scary. I mean, you can target people who are frequent credit card users online, which is kind of a crazy category to have, because it's almost like if a gambling company was targeting people who have a gambling addiction. It's like...
Yeah, target people with gambling addictions.
Like, this guy spends a lot online. Let's go after him. You know he's going to buy something he doesn't need.
He goes to Crown every Friday night.
Yeah, exactly. So that's what it's all about, and that kind of talks to the point that you were making, which is that they obviously run the calculation of whether it's worth complying or whether they should just cop the fine. And in this case, this third-party tracking, as we've seen with the iOS change, I think just the iOS change was a $10 billion hit. So this would apply to all EU users regardless of what device they use. So if they had to comply with this, it would be a massive hit to their business, and it makes sense for them to kind of push back as much as possible. But essentially, the Data Protection Commission says that Meta has 3 months to make changes or they will face this $400 million fine. So it hasn't come down yet, but they're giving them a bit of time to make the change. Although, surprise, surprise, Meta's not going to be doing that. A spokesperson from Meta responded by saying, the suggestion that personalized ads can no longer be offered by Meta across Europe unless each user's agreement has first been sought is incorrect. That's why we strongly disagree with the DPC's final decision and believe we fully comply with GDPR by relying on contractual necessity for behavioral ads given the nature of our services. So contractual necessity is that idea of once you use the app, you're automatically signing the contract. You're giving your permission. As a result, we will appeal the substance of the decision. So they think that they comply. They think that, and I think fairly reasonably, they're offering a free service. They should be allowed to track you, and if you don't want to use the service, you don't have to. You don't have to hand over your data to Facebook. It's not like as soon as you open your laptop, they just take your data. You have to be using their services for them to be using your data. But yeah, it's a very important case, and just another example of regulatory impacts happening to Facebook and Google and these other social platforms over the past few years.
Yeah, does go back to that broader discussion point, doesn't it? As to if you want to use the services or products or services of a private business. I mean, do you have a right to dictate, or should rules be imposed as to how you are or aren't allowed to use this product or service, or do they have that option because it's their product or service? Like, you want to use the app that I made? All right. If you want to, comply with my rules. Yeah. If you don't like the rules, you don't have to use my app, but I won't let you use my app unless you agree to my rules.
Yeah.
See, that's the way my brain in most situations shifts more that way. But there are a lot of people out there that are kind of the opinion that, a lot of these companies are very monopolistic, and they believe that, it's not fair because someone shouldn't be expected to have to forego all 4 of Meta's apps and try and use something else to connect with their friends because, however many billion people are already signed up to them. So, I don't know. I think I don't want to put words in your mouth, but you kind of also lean on the kind of don't use the app if you don't like the T's and C's kind of thing.
Yeah, I'm never against regulation which helps customers make informed decisions. So I'm never against a regulation that says, hey, Meta needs to tell you. Like, it's buried deep in the terms and conditions, and maybe a lot of people who use Instagram aren't aware that when they log out of Instagram and go search the web on Google, that all of those websites, almost all of them, are placing little tracking cookies on your device so that they can track. Maybe people aren't aware of that. So allowing people to be aware of that, I'm completely fine with. In fact, I'm in favor of that. But yeah, at the end of the day, I think Facebook should be able to decide, what the terms of their business is, and I don't think you need Facebook. I mean, I don't think anybody needs Facebook. I mean, there's plenty of ways you can communicate online. There's plenty of social platforms that Meta doesn't own that offer entertainment. To me, I think I think what they're doing is fine. But yeah, I'm always in favor of giving customers, making customers aware of what they're actually transacting with, which is something that a lot of people are not. So
it's kind of like, I don't know, going into the Apple store and buying a new iPhone and saying, I really want an iPhone. Like, I love the iPhone, except, excuse me, you need to put a headphone jack here. You really, you need to put a headphone. I'm not going to settle for no headphone jack. I want you to take this iPhone. I want you to put a headphone jack. And then that's what then I'll get you. It's like, no, Apple can make the iPhone however the hell they want. You can just go buy a different phone.
It's funny you say that because the EU just made iPhone put a USB-C port on the bottom of their phone. So
I know. But this is just the difference in opinion. Some people think that, they should be forced to make a standardized charging. Like, if I was in Apple's shoes, you'd be like, hey, come on, it's our product. You don't have to buy it. If you want to buy one with a USB-C charging cable, then buy a different phone,
Yeah.
There's the two different ways to think about it.
Yeah, that's for sure. Yeah, as I said earlier, the Irish Data Privacy Commission has a strong habit of finding Meta as well. They so this is the $400 million fine they're probably going to make in the next 3 months to Meta. Last year in total, they fined them $900 million. So
right.
Yeah, it's kind of a regular part of the budget for Meta. It's also funny. It comes at the same time as just a couple of weeks ago. Meta is potentially facing an $11 billion fine, or up to $11 billion from the EU as well, in regards to their marketplace being anti-competitive. So yeah, Meta's. I mean, this isn't new for Meta, as we've spoken about. I mean, they've faced the Cambridge Analytica fine, which was like $5 billion, I think, or something like that, and they've been getting fines left and right for a very long time.
Irish Data Privacy Commission's their meeting was all right, guys, look, we need to increase our revenue by 30% this year. So let's make sure that we really hit, as soon as we can, let's start getting that revenue in. Let's start hitting Meta with fines. Yeah, you good? All right. We can, I tell you what we can do. We don't hit Meta with a fine. We'll hit Facebook with a fine. We'll hit Instagram with a fine. We'll double it. Yeah, good. Yeah, all right. Who else? Apple? Apple, can we hit them with something?
Well, I spoke about this.
Google?
I made a video on the $11 billion fine up to $11 billion that Meta might face. I made this video a couple of weeks ago. And the point I made was that a lot of countries maybe fairly feel as though Meta doesn't pay their fair share in taxes because they don't pay tax in most countries where they operate. So they offer this service to customers. Businesses in those countries generate revenue. They pay for advertising, but those dollars go through maybe their Singapore subsidiary, or I think they used to have an Irish subsidiary, wherever the lowest tax rate is in Europe and in Asia. They just funnel the money through there. And as a result, even countries where there could be a lot of advertiser revenue, they're getting nothing out of Facebook. And I think, Australia was one. Facebook's Australia tax bill last year was $20 million, which is nothing compared to the billions that they generated from advertising revenue. But all of it goes through the Singapore subsidiary where the corporate tax rates are really low. So it's kind of it's a funny situation where countries may be justifiably upset, and then they can use their laws to basically get money out of these businesses, even if it's not through tax. It might be through antitrust or data protection or whatever it is.
Yeah, very interesting. Well, starting with a bang, 2023. Cop that, Meta. Should we move on?
Yeah, what have we got?
I want to talk about Tesla deliveries because I just think it's an interesting case of market irrationality.
Oh, Tesla.
Tesla's copping it. I mean, no, they're not. They went up 5% last night, Hamish. They're doing so well.
Just ignore the 9% that have been going down every day for the past 2 weeks.
Exactly. Just ignore the 12% drop one day ago. So CNBC said shares of Tesla closed down, get this, 12% on Tuesday.
Crazy.
A day after the electric automaker reported fourth quarter vehicle production and delivery numbers for 2022 that fell shy of analysts' expectations and the company's stated goals. Now, for context, the company does state that I think the only vehicle production delivery guidance they state is a long-running average of 50% compounded growth. That's all they say. They just leave it at that.
Yeah.
So obviously, yes, they're going to get to a point where 50% growth in vehicle deliveries
is absurd.
Is absurd. It's just physically impossible.
Yeah. I mean, if they're at 10 million, they're not going to do 5 million.
Exactly. So there will be a point, but they say that for the next little while, that's their goal. So anyway, take that however you want to. But it says here, deliveries are the closest approximation of sales disclosed by Tesla. Yeah, that's fair. Before we get their financial data later, the company produced 439,700 vehicles and reported 405,278 total deliveries for Q4. So that gave them, for 2022, 1.31 million deliveries for the year.
Wow.
So quite a few cars. The full year numbers represented a record for the automaker and growth of 40% in deliveries compared to 2021. But yes, as I was just saying before, technically they did fall short as they've been guiding for 50% and they only hit 40, Hamish.
Only 40.
Only 40% growth. Oh no. Jeez.
Disaster.
This is the crazy thing though. And this is what I wanted to get your take on. In 2020, so we're gonna go year by year, okay? In 2020, they delivered 499,000 cars.
Mm-hmm.
Okay, the stock closed out the year $235,
mm-hmm.
split adjusted. Then in 2021, they didn't deliver 499,000 cars. They delivered 936,000 cars,
mm-hmm.
and the stock at the end of the year closed out $352. So it went from $235 to $352. All right, fair. Deliveries went up a lot. and plus a lot of speculation. Then in 2022, they go from 936,000 deliveries to 1.31 million deliveries, and the stock goes from 352 to 113.
Ouch. Ouch,
It's
ouch.
pretty crazy, isn't it?
Yeah, it
It's
is.
pretty
It is crazy. And I've seen a lot of people, I think, I saw a few people on Twitter being like, well, they only missed by this much. Why did the stock go down this much? And it just doesn't kind of work like that. I mean, it obviously depends on where the value of the business long-term is. And for a long time, at least like even earlier in the year, the stock has had baked into it, not only, I think, the auto business, but many other businesses
Full self-driving.
Many other businesses that Elon has been talking up and that I guess we're expected to spawn in the next couple of years. And maybe some of those expectations have come off a little bit, and that the long term for Tesla's, conglomerate energy global business is maybe a little bit longer than people expected, plus interest rate hikes and just a disaster of a year anyway, people kind of rolling out of speculative businesses. But you definitely can't read into the drops in the stock price and the performance of the business. Those two things have been separate for Tesla for an extremely long period of time. It's just been the case that historically it's been small increase in the business or a large increase in the business, but an even larger increase in the stock. Now it's a large increase in the business, but the stock is not doing too great. But I don't know. I don't know what Tesla's value is. I don't know how to value the business, so I can't really speak to what's really happening. But
it's at 35 PE now.
It's 35. Yeah, so it's a lot more reasonable.
It's high for if it's an auto company,
Yeah.
You wouldn't expect that on a Ford or a GM or something,
But Tesla, if they continue to grow at 40-50% per year, then even over just a couple of years, then it's probably justified. It's just a matter of whether that can happen, or whether Tesla is going to start to act more like a automaker, which is that maybe in the next year with interest rates higher and people a drop off in demand, maybe their business will actually be negative. We'll start losing money. Most automakers lose money during a recession. They can't stay profitable because it's a very capital intensive and low margin business. So we haven't seen that with Tesla yet so far. It's just a matter of whether that will happen, and maybe investors are starting to think down that road a little bit. But
potentially, yeah. And this is the classic. This is why Tesla is just so debated. It's just like you can make Tesla look super expensive. You can make Tesla look super cheap. It just depends on what you think the business will be able to achieve in the future. And that's why there's so much arguing about it. It's not like a legacy business that has done the same thing. It's not like Coca-Cola. They've done the same thing slightly better every year for 50 years. No one's arguing about what Coke's going to look like in 10 years from now. No one cares. You can kind of figure that out.
Yeah.
But when it comes to something like Tesla, everybody's got an opinion because everybody lands on a different spot as to where they think the business will be in 10 years. So it's very interesting. But I did want to point that out as to how just like stock price does not equal business performance, because literally nothing fundamental has changed about their business. In fact, I would argue that they're going from strength to strength in terms of the operations of their business and their growth plans and trajectory. They've continued to grow for a long time now. They're not at a substantial risk of financial worry or bankruptcy. They still have very large order backlogs. They've got over 1 million Cybertruck pre-orders. Now, granted, they only had to put down $100 to get that, so a lot of those will fall through. A lot of those will not eventuate. But you'd imagine that's still a lot. Even if, say, half of them didn't eventuate, still a lot of Cybertrucks to make. And yeah, I think it's just very interesting because now I'm actually quite interested in revisiting valuation. Even just like it would be interesting to do a fully conservative car maker only, no Optimus robot, no full self-driving, just none of that. Just do an automaker valuation on them and see where it falls.
Yeah.
It would be very, very interesting.
Yeah, it would
But
be.
Anyway.
I think, I definitely think that would be interesting to see how that was modeled out. It would definitely, if I was going to do it, I would definitely model out, I would model it like a cyclical business, like most automakers are. So not with the expectation that there's just a consistent increase in
not for
vehicle
50% per
deliveries.
year.
No, certainly not 50% per year, but even just consistent increases. You may need to model for years where there's a substantial, 30% drop off or even more in vehicles sold, and what impact that has on their margins. Does it mean they actually have periods where they might lose money, and how that affects the price to earnings ratio? Because it might look good now, but if earnings are cut in half, then that 35 quickly turns into a 70, and then you're talking about quite large expectations from that point forward. So
Yeah, so anyway, I thought that was an interesting case study. But yeah, the stock went down 12% after that was released, and it bounced back 5% overnight. But yeah, 12% drop. It's had a shocking last 12 months.
Yeah, I was just looking. The last 3 months, it's down 65%. So it's
last 3 months.
Yeah, it's actually it's been in complete free fall. What's it down in total now? 72%. So.
Wow.
It's up there. It's up there with Netflix and a
Wow.
few others that have been absolutely destroyed since their peak of last year. So, it's a different environment we're in. Investing environment.
It is very
for sure.
different. Very, very different. How the speculation has left the building. All right, let's talk about this Dubai plan. Well, it's not. I don't know. There's been like a Twitter post about it so far. But Dubai has an $8.7 trillion plan to boost their economy. So, Dubai on Wednesday announced a mammoth. Guess what? $8.7 trillion economic plan for the coming decade aimed at turbocharging trade, foreign investment, and its place on the map as a global hub. They've committed to 100 future transformational projects within 10 years to double the size of Dubai's economy. Quote, Dubai will rank as one of the top 4 global financial centers with an increase in foreign direct investment to over $177 billion over the next decade. Sheikh Mohammed bin Rashid Al Maktoum, the ruler of Dubai, tweeted, quote, over 300,000 global investors are helping build Dubai into the fastest growing global city. So the post outlined a few of the 100 future transformational projects included in the 10-year economic roadmap. Those include boosting foreign trade to 25. Should I just use US dollars maybe?
Yeah, give us
I'll just use US dollars. Yep. Those include boosting foreign trade to $7 billion from $4 billion. In the last decade, nearly doubling annual foreign direct investment to $16 billion, and increasing government spending from $140 billion in the last decade to $190 billion in the next decade. This plan also aims to bring private sector investments up from $215 billion to $270 billion in the next decade. And pledged $27 billion in annual contributions to the economy from digital transformation projects. Dubai has long been a regional hub for the Middle East, but has of late made changes to integrate further with other parts of the world. It is home to a diverse 90% expatriate population and has for many years offered lifestyles comparable to those in the Western world, along with beaches, no income tax, and one of the world's lowest crime rates.
Wow.
So, interesting.
Yeah.
Dubai is just such an interesting... I've never been there, but just looking there, it's always been somewhere that I'm like, I'd really like to go because it just looks very interesting.
Yeah, I don't really know anything about Dubai except I've been to the airport and it's nice.
It's a nice airport.
It's probably the best airport. I think it's the greatest airport in the world, I'm pretty sure. It's just crazy. They have like...
Well, that makes sense. That perfectly makes sense with this story. If you've been not to Dubai, but you've been to the airport, because they're talking about how they want to be a hub. They want to be the place that you go to. Yeah.
Yeah, and I know a lot of people move there because there's no income tax. But yeah, I don't know. It's I really don't know anything about them, to be honest, or how their economy works. But interesting to see.
There you go.
It's one of those. It's one of those Middle Eastern.
Insight.
Yeah, I know. Thanks. It's one of those Middle Eastern places that just have so much money, and they look so impressive. The cities that they built, the skyscrapers.
It's very impressive. Yeah, of course, this is early days. Obviously, I actually really like this kind of like niche. I like mega projects and construction.
Yeah.
For maybe some of you guys might follow a YouTube channel called the B1M. And they follow all of the big like economic development projects, whether it be like linking 3 countries with a high-speed rail network, or whether it's like building the Australia's tallest building in Melbourne or whatever it is. They follow all this sort of stuff. I really like the channel. So I have this weird niche kind of interest in that. I don't know anything about it, but I just have like this interest in it. And that's probably why Dubai's always interested me. But this is clearly all talk at the moment. But and they only said like 5 different pillars out of the so-called 100 transformational projects. It's kind of like wasn't it like the Labor government in Australia maybe a couple of elections ago were like 100 positive policies that they didn't. There's something like that. I can't quite remember, but but I mean, it's just like a number. They just threw out a number, and then they tried to make these 100 policies, but there was like so much repetition. Like 5 or 10 of them were exactly the same because they just wanted to market 100 positive policies.
Yeah.
But they probably had maybe 10, and then the other 90 were just like, we want to be happier.
That's classic politics for you.
Yeah, exactly.
Yeah.
So it seems like that's kind of the same thing. It's just like, guess what? We're going to double the size of Dubai's economy with this very sketch, like pencil drawn in plan that we haven't quite figured out yet.
Yeah. Well, when they do it, we'll go visit. We'll go check it out. Then we'll give boots on the ground. We'll take a look.
But I mean, they're doing like they're definitely trying to appeal to the Western kind of crowd. They ditched their 30% tax on alcohol recently to try and boost tourism. They changed their Islamic weekend, which is Friday, Saturday, to the Western weekend of Saturday, Sunday, to try and accommodate the Western world better.
Interesting.
And be more of a business hub. So yeah, I mean, we'll see. They certainly are taking action in that kind of regard. But anyway. All right, I think that's everything, right? Should we do a Q&A question or two and then jump?
Yeah, let's see. This is an interesting question. I'd like to hear your thoughts on this one.
Yeah, sure.
How do you manage your time and how do you persuade yourself not to procrastinate? I'm starting to read my first annual report, Costco, but it's so slow. I just can't kick myself to read it. P.S. I love your podcast and I'm always looking forward to listening to it the next week. Well, thank you for tuning in every week.
Yeah, much appreciated. I think that you haven't found the right company yet. I'm not saying Costco is a bad company, it's a great company. But I think if you are really struggling to read an annual report, I mean, first of all, I should say, if you haven't read an annual report yet, don't try and read an annual report cover to cover. That will just make you cry. What you should do is you should read the first section, which is about the business and what the business does and how they make their money. Then maybe you want to go through and have a look at some of the financial results and see actually, okay, so you said you make your money like this. How much revenue do you make from doing this? How much revenue do you make from doing that? How much money do you get to keep from doing this? How much money do you get to keep from doing that? You know, what's important to you? What's not important to you? That's how I would start reading an annual report. And then after that, just get a feel for whether, read about the company, think about whether you're actually interested in learning more, maybe for Costco, I've never read a Costco annual report because it's just not in my circle of competence at all, but maybe it's quite complex. Maybe the reason that you're struggling to read it, and maybe not, I should say maybe not, maybe you're very competent at this sort of stuff, but maybe the reason you're struggling to read it is because it's really difficult. I mean, there are lots of annual reports that I try and read and I'm like, what the hell is going on here? And it's that point, if you get to that point, you just chuck it on the too hard pile. You can't force yourself into it, I guess.
Yeah.
But I think if you're really struggling, that's what I'd say. I'd say if you're not struggling as in this is difficult, but just like struggling as in, this is not motivating, I would say maybe go back and think about what your interests really are, what businesses you use every day just naturally and you already have some kind of context with, and maybe look at one of those ones instead.
Yeah. I don't think there's anything too much I can add to that. I think focus on things that you're passionate about, because that's where it'll come easier. The other thing I would add is that I find it helpful to have, I think it depends on your personality type, but I need things to be scheduled and structured in order for me to be productive. So I need to have things broken down into little tasks that I can tick off throughout the day. So not just applying to reading annual reports, but whatever you're doing, breaking it down into small tasks, scheduling it out, having kind of little milestones, to get you ticking kind of along the road. And you can do the same thing for annual reports, whether it's each milestone is one annual report, but even within it, you can kind of break it down into little steps for analyzing different companies. So that's what I would do.
Yeah, you could do Monday night before bed, I'm just going to read the business heading, where they talk about what their business actually is, just like the description of the business. And then Tuesday, you read the risk factors.
Yeah.
Wednesday, you read the financial results. Then Thursday, you read what the management says about the financial results. Maybe break it up like that. That could be good. I like that, Hamish. All right, let me ask you this one. Would appreciate hearing how you select sponsors and affiliates. Has your thought process changed over time? Have you ever faced a tough decision on whether to accept one?
Yeah, that's interesting. I think at least for me personally, it's always just kind of been the services that I use. And then if I'm using those services, then I think, maybe there's a deal that I can get with I can leverage my position to get a deal with the audience that, maybe it's the same deal that other affiliates can get, but maybe it's a better deal. Maybe I can try and get a better deal. That's always just been my position, is just, what am I using? What are the things I use? I used Sharesight for a couple of years. I was like, let me just reach out to them. I don't think they even had an affiliate program when I reached out to them. And then, then they began to set it up. And the same thing's been true with other, businesses that we've worked with, where they're either just getting started with their affiliate program or we've just reached out to them and see what they have. But that's been the way I've kind of gone about it. I've never really gone, at least not yet, into the route of taking more advertisement sponsored segments where there's less of a relationship between me and the service. I haven't felt the desire to take those yet. So I haven't really been facing decisions, in that way. But yeah, up until now, it's just what I use basically. How about yourself?
I have a framework where it has to be a win-win-win. That's my only. Well, that's not my. I do need to use the platform. I do need to be very familiar. Like, what I use: Ticker.com, Sharesight, Simply Wall Street, Seeking Alpha. They're the main ones at the moment. And I use all of them, so it's fine. So that's definitely one, but it definitely has to be, for a sponsorship agreement, it has to be a win-win-win. So first of all, of course, the business has to win, because otherwise they wouldn't. It's not an attractive opportunity for that. Obviously, it has to benefit me, because I've got goals that I need to hit with the channel, financial or whatever it might be. So it has to benefit me. But at the same time, I don't want to accept a sponsorship unless there's also a benefit to the audience. So a lot of the times I ask, is there some sort of, like, for example, Simply Wall Street, is there some sort of discount that maybe people that follow my channel, because, the way that they see it, Simply Wall Street, they're like, okay, well, sure. I mean, we're hitting a very targeted demographic of people that are specifically interested in stock market investing. If we give them a discount, then chances are they're probably going to stay with us for multiple years, because they're actively interested in what we've got to offer. So I always like to see that there's also some sort of benefit, trial period, discount for the people that follow the channel, so that they actually get something out of it. So it's a win-win-win situation for me, and that's what I like. Have you ever faced a tough decision to accept one? Ultimately, no, but there are a lot of sponsors which don't align with our values that offer us a lot of money.
FTX.
Yeah. But that's the only thing. When you think about, like, for example, I'm looking at my business, and at the moment I've got 3 employees, and I'm looking at my rent costs, and I'm totaling it up, and I've got this amount of fixed costs that I have to meet before I even make $1, you know? And then you just get this opportunity or offer that comes up, which is, you know, very substantial, but it's just not with a company that quite aligns with your audience, or you wouldn't use it. For example, one that's come up has been a sponsor that offers a way to invest in artwork, securitized artwork, but I don't know anything about artwork. I've never spoken about artwork on my channel. So
yeah, it doesn't really align.
It doesn't align. Yeah, it doesn't align. And I wouldn't feel confident that I would be able to do the due diligence required to know that business is really up to scratch.
Yeah.
So yeah. But yeah, no, that's definitely, and that's why you can understand why so many people got busted with this FTX stuff, because you're right, you run a business. If you see a big financial opportunity that you could, that covers your staff salary or something like that.
Yeah.
It's like, oh, I want to shake your hand on that, because that would be very beneficial to our business. But yeah, you just can't, I don't know, you just can't do it if it doesn't align.
Yeah, for sure.
Yeah.
All right,
cool.
We'll leave it there for today. Thanks everyone for tuning in. As always, if you have any questions, feel free to head over to the YouTube version of the podcast and leave them as a comment on the latest episode. Or if you're listening on Spotify, then you can just scroll down below, and there'll be a box there for you to ask your questions. And we grab all of the questions, put them in a doc, and try and get to a couple at the end of each episode. But thanks for tuning in this week. We look forward to another great year of the Young Investors Podcast. What episode will be? Will be around the 250, 260 towards the end of the year. I'm trying to think where we're going to get to. We're not going to quite get to 300.
I was like, mate, I thought this was episode 200.
No, I'm trying to think we'll get to the 250 milestone, hopefully. But we probably won't get to 300, unfortunately. But
no, definitely not.
No, that would be a little bit sub.
2024. Yeah.
But thanks for tuning in. Looking forward to the year. Thanks, Brandon, for joining me this week, and we'll see you guys
next week.